If you would know the value of money, go and try to borrow some. Benjamin Franklin. Money, money, money. Hello, welcome to Dragon Financial. I'm your host, Brad. Have you ever wished for more money? Or maybe just to understand finance? Here at Dragon Financial, we do things a little bit differently. Every episode will take us on a planned series of learning more about money. This is a journey that will take us through the history of money and teach you what you should have learned in high school. Our team has prepared a multi part series to teach you the basics of money and finance. So if you want to master money and finance, subscribe to the Dragon below to take this journey with me. After we've learned the basics of money, we'll dive into the stock market, and we have several more series coming your way. We can't promise to take you from zero to hero, but we'll try our best. So let's dive in. Today, we'll be looking at loans. A loan is borrowed money. The most common reason to borrow money is for a house or car. But we can also take out student, personal, or payday loans. So let's dive in and see how loans work. This is Brad. Brad wants to buy a car, but he doesn't have the money. So he goes to a bank and asks them for a loan. The bank says you can have a loan for $30,000 for 60 months with the car securing the loan in an interest rate of 6%. Let's take a look at what all this means. First, we need to understand some basic terminology. The loan amount, or $30,000, is called the principal, and it is how much money you borrow from the bank. While this number is up to you and how much you want to borrow, your chances of approval depend considerably on your credit score and your income. We went over your credit score in the last lesson, and I'll post a link so that you can review the key factors in your credit score. We also need to take a look at the interest rate. For Brad's car loan, the rate was 6% per year. On a $30,000 car loan at 6%, that means you will pay $1,800 in interest per year. However, the bank usually will charge you monthly, so you will pay $150 per month in interest. This will be 0.5% interest rate per month. Lenders calculate the annual percentage rate, APR, by multiplying the monthly rate, 0.5%, times 12, the number of months in the year. Below, I've included the formula for the annual percentage rate, or APR. The APR equals the periodic rate times the number of periods in a year. Or, for our example, APR equals 0.5% times 12, or 12 months, equals 6% per year. If you like money, hit the like button. After calculating the APR, we now know you will need to pay $150 of interest per month. The banks apply your payment to this amount first before they apply it to reduce your principal or loan amount. So after the first month, your loan is actually $30,150. And of course, the bank is going to want its 6% interest, or APR, on the $150 as well. So you will actually end up paying more than the 6% rate. We can calculate this additional rate using the annual percentage yield, or APY. And it comes out to approximately 6.17% per year. So you'll actually be paying this higher amount after accounting for the interest the bank charges on the interest. This additional interest on interest is commonly called compound interest. Compound interest is awesome when it is working for you, but not the greatest when it is working against you. Let's look at the formula to calculate the annual percentage yield, or APY, below. So the APY equals 1 plus the periodic rate raised to the number of periods minus 1. So what this means in our example, I have shown in the calculation below. So I'm not a big math guy, but you can read the math below to find out the rate of 6.17%. In my experience, APY is the most common way to calculate a loan. Next, we'll look at how long the bank is giving you to pay the loan back. This is known as the term. And for Brad's loan, the term is 60 months, or 5 years. The shorter the term, the higher your monthly payments will be. The longer the term, the lower your monthly payments will be. But low monthly payments are not always a good thing because that means less of your money is going towards paying down the principal and more is going to pay the interest. In general, the longer the term, the more interest you'll pay over the life of the loan. Finally, let's talk about secured and unsecured loans. A secured loan means the bank can take the asset if you don't pay the loan. Brad secured his loan with the car, meaning the bank actually owns his car until he finishes paying the loan. A secure loan has a much lower interest rate than an unsecured loan. An unsecured loan does not have any underlying asset and is therefore much more expensive and risky. In general, banks want the loan to be secured. All right, let's do a quick review of everything we've learned. The principal is the amount of the loan. APR, or annual percentage rate, is the yearly interest on the loan. APY, or annual percentage yield, is how much total interest you have to pay per year. Compound interest is the interest you pay or receive on the interest. The term is the time you have to repay the loan. Secured means you pledge an asset to guarantee the loan, while unsecured means there is no asset to guarantee the loan. I will leave timestamps in the description below so you can quickly review any of these topics. All right, what do you think? Should Brad take the loan and buy the car? Hmm. Taking a loan is not necessarily bad. I have taken several loans out when I needed them. The important thing is to understand the risks with a loan and have a game plan to pay the loan back on time or even early. Remember, this is not financial advice, and I am not a licensed financial advisor. These are my personal thoughts and opinions. I hope you enjoyed our journey today as we explored loans. Join me next time as we look at real estate in our series on money, what they didn't teach you in high school.